I was having breakfast with my a family member this morning, and the question that he stated to me is, Scott, what's do you know anything about this AI bubble? That's what he says to me. Do you know anything about this AI bubble? And I said, well, you do know the industry I'm in, correct? Like, he said, yeah, but that's not AI. I'm like, well, I said, you do realize we manage 35 billion for 25,000 clients or whatever it is. Like, I kind of,
he got
and I didn't want to get into discussion of whether we're in a bubble or not, because I don't know if we're in a bubble or not.
We don't know. It's the whole thing about bubbles. Right? People say we're in them. Sometimes we're in them. Sometimes we're not. Sometimes you don't know you were in them until it's done. But if you've been a long-term listener of this show, we constantly, incessantly, overly harp, nonstop. How many different words can I?
I know. I'm waiting for what are we talking about?
Of keeping your portfolio balanced
and having the right discipline going through all market cycles,
which means it points at time you take gains, and it points at time you have
losses.
You have losses, and you balance the portfolio regardless of the marketplace to whatever your investment thesis is.
That's exactly right.
Regardless, up and or down.
It's funny if you just go and look at your Apple iPhone and do the stock ticker thing and look at the S&P 500. Just look even the last year. Oh, it's like a short-term blip or downturn.
So let's say you started a portfolio with 50% stocks and 50% bonds and cash 24 months ago. Right? It isn't even close to that now.
Yeah, you're way out of balance.
You're way out of balance. Way out of balance. And most people,
50%, like the only things that's done better than stocks last couple of years, I guess, has been gold.
Yes.
Which is an obscure, whether it's an investment or not is another question. But
yeah, it's
but I mean, like commercial real estate hasn't done great. Residential real estate hasn't done well. No. But stocks have been on fire.
Yeah.
And historically we have a 10% pullback once every like 9 months. I mean, and we had one not long ago. If you just earlier in the year, we had
it was very short
a correction. And they're very typical that we have these short-term pull. And we have a 20% decline, a bear market, about once every 3 or 4 years, depending on the time frame you want to look at.
Yes.
They're very common, these market swings.
Most people are reluctant to rebalance a portfolio in an up market.
Or sell, yeah.
Right? Well, it's doing well. It's doing well. I can't tell you how many times in my career it's doing well. And I always say it did well. The mere fact that we can measure it means it's historical. It's not doing anything. From this point forward, your stock isn't doing anything. It did well.
And the only thing that's going to change the value is people's perception on the future of the company.
Correct.
Not what the company is doing today, what it did this last quarter. It's people's perceptions on tomorrow and 5 years out.
Yes. And so we harp constantly about rebalancing the portfolio because it's a risk-adjusted rate of return is what you're interested in.
I guess there's a couple ways you can approach investing. One is you could have an investment thesis where you own a variety of different asset classes. You maintain a certain allocation of those asset classes. You rebalance. Maybe part of your thesis is that you allow a little bit of flexibility in the rebalance depending on some economic factors, but you don't bet the farm on it, right?
Yeah, yes.
You don't take any risk that you can't recover from. That's one way to go, which is what we would subscribe to and have subscribed to for years. The other is, well, let's try to pick what's going to do well next. Let's get out of those things. Let's try to pick the best stocks, get rid of the worst stocks, or maybe we'll sell short the worst stocks. And then let's try to figure out when we should get out of the market entirely and figure out when we get back in the market.
That is an investment thesis.
Correct. And I think a lot of individual investors live their lives that way for a period.
Yes. That is
for a period until they get burned.
this. It makes me laugh. I met with some clients and last week. I think it was last week, and it was his birthday. So he came in, and someone had given him a lottery ticket, and he said to me, "I don't know if we really need to do any of this, Pat. I've got this lottery ticket in my pocket." And I said to him, "That is an investment thesis. I don't know how sound it is."
It's not going to work out for the vast majority.
And obviously it was all said in humor, but I thought to myself, there are people that believe that they somehow have a magical touch in picking something that is going to go to the and you've seen them and I've seen them where people who have bet the farm on something,
Yes.
because they have convinced themselves that they somehow can see something no one else can see.
Do you ever listen to the podcast, the All In podcast?
I've never.
Oh, really?
No.
There, David Sachs and a couple other and Klamath. I can't pronounce his last name. That Klamath. They're all venture billionaire guys. Extremely bright,
Yes.
right? And I actually think you'd enjoy it because it's a variety of topics.
Called All In.
The All In podcast. Variety of topics. Sometimes it's political. Sometimes it's usually much more focused. They get in deep in the weeds. But some of the things they bring up, and here's why I enjoy listening to it. Like, I know my intellectual level. I'm fortunate to be maybe a little brighter than the average, but I'm not a genius, right?
I think we can all agree.
Okay. Well, I mean, I'm just. Yeah, part of being an investor is getting to know yourself.
Okay.
And I listen to these guys, and sometimes when they have some of their guests on, I'm like, these guys are really bright. And I could not imagine taking an opposite side of a trade against these guys.
But even
though those guys understand,
if you talk to someone
one
who's
guy's talking about how he would never sell short, how foolish it is to sell short because he doesn't believe he can figure out the market cycle.
right, and they will talk about some of their losses, I hope, at points in time.
Of course, yes.
Right? The best investor.
Yeah, if you listen to this week's, they would be talking about what the last couple of weeks were and the declines they had in their own stuff. But I was just thinking the other day as I'm listening to these guys, I'm thinking the average person who thinks that they're going to be able to pick the best stocks and get rid of the worst stocks, they're competing against the brightest minds, the top mathematicians that are graduating from the top schools,
And computer scientists.
Correct. Right.
I mean, there's not just intellectual that goes in there. There's a ton of technology that goes into a lot of investment.
And when you look at the numbers, like you look at professional managers, how many actually outperform their indexes, it's like 20%.
Yeah.
And then if you look at the studies and say, okay, the guys who outperformed or the girls who outperformed, I shouldn't call them girls. I guess you can call guys and ladies. Guys and gals. Gals and old.
How old are you?
I'm old enough to say gals.
Okay.
Because I use the term every once in a while. My daughter teases me.
I know.
What? I don't know.
The middle age is called. They want their vocabulary back.
I'm not middle aged. I think I'm beyond that.
No, I meant the Middle Ages. Not you.
The Middle Ages.
Victorian England called.
You look at professional money managers. There's tons of studies out there, right? The professional money managers, the ones that are in the top quartile, right? So these are the top 25% of money managers. You look 5 years, the subsequent 5 years, it's a vast minority of them are continue to be in the top quartile.
Which is why I always ask myself, do you attribute this to genius?
There are
Luck?
economists and finance professionals who completely believe it's 100% random and it's all just luck. And there are some that say no, that the skill's involved as well. And
there's probably a combination.
There's probably a combination of both. There's some that I think it's just luck. Look, you get 100 people in a room and I'll do a flipping the coin contest.
Yes.
Someone's going to be like, wow, I can't believe you know how to flip 10 coins in a row. That's heads in a row. That's amazing. Look at you, right? I mean,
yes,
same concept.
It's random.
And
but goes back. If you haven't rebalanced your portfolio in the last 18 to 24 months, you really want to look at it now. Because it's even in this recent downturn, right? And we're recording this on Tuesday,
whatever the date is.
Yeah.
Tuesday before the Saturday.
Okay. There's still lots and lots. Your portfolio is still out of balance.
Yeah. And even if just because we're down, I mean, we're
not that far.
You go back and look where we were.
It's just the day after day. It wears on people.
Well, markets tend to. They talk about markets climb a wall of worry. It's an old saying, because there's always that a bit of trepidation, like maybe the shoe's going to drop. There's what bad news is lurking around the corner. What's the employment report going to say? The jobless numbers, the whatever, the GDP report, the inflation report. People are always a little worried that something bad, some news is going to come out that's going to cause the markets to decline. And it feels, I don't know, it actually occurs this way. The market pullbacks, daily pullbacks, tend to be stronger, more pronounced than the upswings. So it's easy to have a 1%, 1.5%. It's more frequent to have that than it is to have on a gain of that day. We tend to climb a little slower and fall a little faster.
And I will add to this, especially if you're taking distributions from your account to live on, the market pullbacks feel a lot worse.
Oh, if you're living on your stash of cash.
Yes.
So to speak.
Yeah. That's why you want to set aside.
Yeah, and it's also, I think it's a good time, and if you are, or nearing retirement where you're going to be dependent upon your assets, getting a good handle on how much money do you have that's not tied to risky assets, that should we go in another downturn in the stock market, a recession, that we're not forced to sell something, that we can just live off
the money that we set aside because of the asset allocation, how I modeled the portfolio.
Yeah.
100%.
And so if you find yourself nervous, like, oh, crud, where's this going to lead? Maybe it's a good time to meet with your advisor and say, hey, how are we doing here? What do we actually, when would I be forced to sell some of my stocks, or what other riskier assets you have? But look, over the long term, I like to remind people, or at least our listeners, I don't know who else cares. You're listening because you care about this stuff. So here goes. When I started in this industry, July of 1990, the Dow Jones Industrial Average, what are we at today? 45, 46, 40, whatever. 40, it's approaching 50,000. 40, whatever it is. The Dow Jones Industrial Average, July of 1990, was 2,600.
It's amazing.
That's a long period of time.
Yes.
Right? But look, if you're 60 years old, if you're a married couple 60 years old, there's a greater than 50% chance one of you are going to be alive into your 90s.
Yeah. If you're in your 80s, there's a good chance one of you is going to be alive
in your 90s.
In your 90s.
So, and if you have more assets, more dollars than you're going to spend in your lifetime, the time horizon for your personal investments are probably much longer than even your life expectancy is.
As they should be.
So
it's normal.
Highly normal. No one likes them when the markets go down. I don't like it either. Actually, I like 1 or 2 days, but when there's multiple days, then I'm like, oh, this isn't.
What are you going to do about it?
Nothing. I try not to.
Yeah. Obviously, you don't react.
I remember this was a number of years ago. The Dow was probably at 22,000 or something. A number of years ago, we're in a business meeting, and with well, it was a board member. I'll just come out as a board member. And the market was having a bad day. It was a couple days leading up to it. That day was particularly bad. And I was frustrated about someone who'd worked for the organization that wasn't doing what they were supposed to be doing. I was frustrated. It was a minor thing, but I was frustrated. And the person says to me, wait a minute, the market's down, whatever point it is today, and this is what you're worried about? And I said, well, I have no control over the markets. Yeah. I think I have some influence over the people that work here. So I'm not going to worry about the markets. Like, this is what the markets do.
Yes.
Like, if it's raining tomorrow, well, it's winter and it rains. Like, this just happens. Like,
there's nothing you can do about it.
Yeah. Anyway.
But it would be so good if you could actually, if you had that ability to know when it was going to go up or down. And so many people actually say they have.
Well,
but they never You don't read about the times that they were
Of
out of the
course.
market.
I mean, we could point to in the Great Recession, the couple people that were accurate in predicting things, John Paulson
And then you look at their trades afterward.
Yeah, of course. But how many other people had a different perspective that you never heard about?
That's right.
Because they were believing something different. So